Hello and welcome to this week's vlog with me, David Jones, and Trading 212. This is for the week commencing May the 8th. Now last week was a pretty busy week. We had the Fed interest rate statement on Wednesday night in the US, and of course on Friday we had the latest non-farm payrolls released, the US unemployment numbers. Expectations were for about 180,000 jobs to be added to the US economy back in April. The number came in slightly better, 211,000 jobs were added. Market reaction initially was a little bit muted because it wasn't that far off the expectation. Now looking ahead to this week, we've got a bit of a quieter week after last week's fun and games. The things to look out for on Thursday lunchtime, 12 o'clock UK time, we have the latest interest rate decision from the Bank of England in the UK. No surprises expected there, but the pound will always be one to watch because it has been recovering quite strongly recently against the US dollar. Then on Friday the focus switches to the US, so 1:30 Friday lunchtime we've got the latest inflation data out of the USA, and that can have an impact. Again, FX markets tend to be the ones that move around, so we have something of a quieter week to look ahead to this week. One of the biggest stories from last week, one of the bigger movers, was the price of oil. We've seen quite a slide in oil over recent months, so that's going to be the market that we take a look at this week. But before we get into that, let's talk about our strategy session for this week's vlog. Now, in recent weeks, we've been looking at a more mathematical approach to markets. We've looked at moving averages and oscillators. So I thought this week, let's go back to basics. Let's look at a really simple pattern that can help us try and predict that trends could be coming to an end. So let's find out a bit more about double bottoms and double tops. Let's take our usual fictional market, and we'll say this market has been trending lower. So it's been making lower highs, lower lows, just slipping lower. And it gets to a point where it makes a low. Market rallies, but again, once again, as it has done all the way down, it runs out of steam ahead of the old highs. So it might rally a bit, turns down, and it looks like the downtrend is going to continue. But then we get this happening. This is our potential double bottom. So the latest low finds support ahead of the old low. In the textbooks, it would be exactly the same level. Of course, in the real world, it doesn't work like that. So this is when we have the potential for a double bottom. And from a textbook point of view, what the market has to do to complete the double bottom and make it a valid signal is to break through that previous high. So that's the double bottom. And again, from a theoretical point of view, the view is if the market breaks this level here, it should move at least the same distance of the height of the double bottom. So if that, for example, is 50 points high, then we're expecting it to move at least 50 points following the break and the completion of the double bottom. The only problem, of course, with buying in here is that really your stop loss needs to be the other side of this low, which can be quite a way away. So there's a couple of, I suppose, different ways of trading this. Let's take some steps back here. Let's say we see that forming. Then an aggressive approach would be to buy when we get the market holding over the previous low. So we're a buyer here. We can have a much tighter stop loss, and we wait to see if the double bottom completes and the market moves higher. The risk is, of course, we're buying before that double bottom has officially completed. Another approach, rather than buying on the break, markets seldom move in straight lines. So wait to see, does the market dip back a bit, then find some support? So we're buying after the double bottom. If we're buying in somewhere like that, once again, we can have a bit of a tighter stop loss than waiting for the double bottom to complete. There's no right or wrong way here. Some people will want to be more conservative. Some people will have a more aggressive approach. And then, of course, the flip side of a double bottom is a double top, where we get a market, hits a level, then rallies back, but can't break that previous high. So once again, the textbook approach for the double top is when it breaks below that previous low, but the measuring and when it comes to placing stop losses is exactly the same. So that's the theory of what is a very simple pattern, and it's very common. You'll see it over all sorts of time frames in different markets. So that's the theory as usual. Let's have a look at an example from a real market to see how this plays out in the real world and where we could have taken the trading opportunities. So here's a real world example. This is Euro US dollar. What we're looking at here is a 4-hour chart, 4-hour candlestick chart. So every candle represents 4 hours of trading. And the potential double bottom was setting up at the end of February, beginning of March. Let's just walk through what was happening. So the euro had slid for much of February from the highs above 108, slid down to around about the 105 area. Then it rallied, came back again, but you can see we haven't at this point here taken out those previous lows there. You know, all the way down, the market was slipping through the previous lows. So here we've got the potential for a double bottom. Let's put our line on. So this is the level really we're looking at, that 104.95 area. So an aggressive strategy would be to be a buyer here with a stop loss underneath that low. So that would be our aggressive one, anticipating the double bottom. The textbook approach is really to wait for these old highs to break. Let's walk through and see what happens next. So the market does rally. It rallies quite sharply off that level, comes up to the previous highs, then starts to back away. We get a bit of a spike through. So again, if you wanted to buy in, the market sold off. So another approach is to wait to see if this level holds again and look to buy in. So we're buying in maybe here with a stop loss below those lows. And then eventually the euro does get a move on, breaks out of that double bottom pattern, and then does proceed to move quite sharply higher over the next couple of weeks. So there's an example showing that it does actually happen and work in the real world. They don't work all the time, you know, but again, when it comes to trading, we can use these sort of patterns to try and stack the odds slightly in our favor. So we have relatively low level of risk, but high level of reward. And if these patterns do pay off, you know, we're hoping for a sizable move in the market afterwards. Now, I said one of the biggest moves last week was the price of oil. Plenty of volatility there on fears of oversupply and worries, as usual, about the Chinese economy slowing down. So we've seen some big moves in oil. It's always an interesting market to watch. Usually plenty of volatility, some decent swings day to day. So our market for this week is oil. Let's take a look at the bigger picture and find out maybe some big levels to keep an eye on in the coming week. Let's start off with our big picture view of the price of oil. So this is going back to August 2015. And of course, we saw a real hard sell-off in oil at the end of 2015 and into 2016, where it traded as low as $26 a barrel. Then for much of last year, we saw a recovery. And by the beginning of this year, oil was sort of up around about the $55 a barrel mark. So if we were looking at the trend, it would probably look something like this. If we took it off the old lows, the price of oil was trending higher, and there's our trend line. This got broken fairly decisively at the beginning of March. The market rallied but couldn't break through those old highs. But I do think it's left us with some interesting levels to watch this week. During September through November, the sort of $42.5, $43 area proved to be a real buying zone for the price of oil. It proved to be good support. So I think it's going to be an interesting one to watch this week to see, do the buyers come back in ahead of that level? I think if that level breaks, if we see more selling, then we're starting to look at those lows from the summer, just below $40 a barrel. But it's declined this year off the highs, something like almost 20% to the low that we saw on Friday. So I think it's going to be an interesting one to watch. Looking at the RSI down here, we've talked about this relative strength index in the past, where it gives us overbought, oversold signals. And it's not done too bad a job when it's been oversold in the past, the RSI below 30%, calling the low. And at the moment, you can see just how oversold it is. So I think maybe if we see some strength coming in this week, that will make the sellers think, okay, the move is over, we're back towards old support, and we can start building a base. But I think it's going to be a really interesting market to keep an eye on. That's it for this week. Plenty to be watching as usual. If you like the video, click on the thumbs up at the bottom. If you click on subscribe, you'll never miss any of these. You'll get notified when the next one's up. And of course, if you'd like us to cover anything in the future, just leave us a message in the comments below. But for this week, from me, David Jones and Trading 212, we'll wrap things up there, and I hope you have a good trading week.